Hi guys, most traders think a channel is just two parallel lines, but professionals use channels to identify trend direction, entry and exit points, and even market strength. Today I'm going to teach you how to understand ascending channels, descending channels, micro channels, and hidden channel structures in a way that you can actually use on a real chart. All right, let's get started. A price channel means price moving between two parallel lines. The upper line acts as dynamic resistance, and the lower line acts as dynamic support. Price moves up and down and fluctuates between these two lines. In simple terms, a channel represents a controlled trend, meaning price is moving along a defined path, not randomly or chaotically. In an ascending channel, both highs and lows are formed progressively higher. To draw it, follow these steps. First, find two rising lows on the chart. Second, connect those two lows to create the lower trend line. Third, draw a parallel line from the first high and extend it to the higher high. Just like that, your ascending channel is complete. Keep this in mind. You should see at least 2 to 3 price touches on the channel boundaries for it to be valid. And one important note, a gentle slope usually means a healthier, more reliable trend. A steep slope increases the probability of a channel breakout. Now let's move on to how to trade ascending channels. Here we usually have two main approaches. The first, and most important one, the best entry point is the third or fourth touch of price at the lower boundary of an ascending channel. Why? Because before the third touch, the channel hasn't fully formed yet, and it doesn't have enough validity to trade. But after the fourth touch, you also need to be more cautious. That's because liquidity often builds up in these areas, and the market maker clearly knows that many buyers' stop losses are sitting right below the lows that he has created. So, what's the conclusion? We focus specifically on the third and fourth touches of the channel low. Now for entries, we have two professional methods. Method 1. Wait for candlestick confirmation, and after seeing price reaction, enter the trade. Method 2, this is a more aggressive entry. We enter the trade with a stop loss placed below the previous low while managing risk properly. Summary: don't enter too early and don't enter too late. The golden zone for trading an ascending channel is the third and fourth touch. A descending channel is exactly the opposite of an ascending channel. Here, price moves step by step to the downside. To draw the descending channel, follow these 3 steps. First, find 2 lower highs on the chart. Second, connect those highs to form the upper trend line. Third, draw a parallel line from one of the lows to create the lower boundary of the channel. The top of the channel is a good area for selling. The bottom of the channel is where profits are usually taken or trades are closed. And one very important point, when the top of a descending channel is broken, it often signals weakening selling pressure and can mark the beginning of a trend reversal. So far, we've talked about channel structures. Now let's move on to one of the most important topics, channel breakouts. And after this, we'll jump onto the chart and go through real examples so these concepts really make sense. First of all, we need to understand that a channel doesn't last forever. We can say a channel has come to an end when price breaks out of its main boundaries, meaning the upper or lower edge, and the market is no longer respecting the rules of that channel. But here's a very important point. Not every move outside the channel is a real breakout. Many times, price just makes a quick spike or a shadow outside the channel and then moves right back inside. These moves are usually considered fake breakouts, and they can easily lead to bad trading decisions. So when should we consider a breakout valid? The first key sign is a strong candle close outside the channel, meaning the body of the candle closes completely outside the structure, not just the wick. The second confirmation, which makes the breakout much more reliable, is when price creates a new high or a new low compared to its previous moves. That's a strong indication that the market has truly shifted into a new phase. And now for the interesting part. After a valid breakout, price will often come back and retest the broken channel level, what we call a pullback. This is usually one of the best opportunities to enter a trade, typically in the opposite direction of the channel price was previously moving in. One very important tip about drawing channels that you definitely need to know. When we want to draw a channel, it's better to use the double layer method. In this approach, we draw two types of channel lines. The first channel line is created by connecting the wicks of the candles together. The second channel line is drawn by connecting the closing prices. This method becomes especially useful when we have long wicks at market highs and lows because it helps us see the real price structure more clearly. It also gives us a defined zone where we can expect potential market reactions. All right, let's start by looking at a real example on the chart, and then we'll move on to the concept of microchannels. Just like we covered in the lessons, we've drawn a clear channel on the chart. If a trader is patient, the third and fourth touches of the channel often provide some of the best trading opportunities. On the third touch, price reacted to the first layer of the channel, and we got a strong confirmation candle. That confirmation gave us a solid entry signal. Then came the fourth touch, where price reached the second layer of the channel. Once again, we saw clear candle confirmation, which allowed us to enter the trade and capture an excellent reward. Now, during the fifth touch, price still respected the channel. However, based on this strategy, it's usually better to focus mainly on the third and fourth touches, since that's where the highest probability setups tend to form. And then we get to the sixth touch. This is where the channel finally breaks. But here's the tricky part. After the breakout, we don't get a proper pullback to the broken level. This is exactly the kind of situation where the market can frustrate traders. You wait patiently for your ideal setup, but it never shows up. So what do we do in this strategy? This is where microchannels come into play. After seeing a strong breakout against the main channel direction, we shift our focus to lower time frames and start looking for microchannel structures to find new trading opportunities. Now, let's dive deeper and learn how to actually use microchannels in our trading. Microchannels are smaller structures that form inside a larger channel, and they help us understand price behavior with more precision. That's why it's usually better to analyze microchannels on lower time frames compared to the main channel's time frame. One very important rule is that trades taken within microchannels should be aligned with the direction of the larger channel. For example, if we have a major downtrend channel and we want to trade within its microchannels, we should wait for a bearish microchannel to form. Then, the ideal approach is to look for short opportunities near the top of that microchannel. On the other hand, microchannels can also help us optimize our entries when trading the main channel itself. Let's say you're planning to enter a short trade inside a larger bearish channel. One more advanced method is to wait for a bullish microchannel to push price up toward the top of the main channel. Then, once that bullish microchannel breaks, you can enter your short position with greater confidence. Let's look at a practical example of microchannels. The first step is identifying the main channel on the chart. Once we recognize the overall market structure, we can then start looking for smaller structures within it, the microchannels. As you can see in this image, once we determine that price is moving inside a descending channel, our focus shifts to the formation of a bullish microchannel. In this situation, we wait for that bullish microchannel to break. After the breakout happens, we look for final confirmation through a strong candle closing in the direction of the break. At that point, we enter a sell trade, aligned with the main trend of the larger channel. This type of entry usually provides a very favorable risk-to-reward ratio and is considered one of the more professional ways to trade in the direction of the trend. If you found this video helpful, make sure to like it and share your thoughts in the comments below. And if you want to learn more about the market and build your own strategy using practical tips you won't hear everywhere, be sure to subscribe to the channel.